Jinesh Gopani, good morning. Thank you for joining us. Jinesh, for an average investor, the news is markets are at an all-time high. We can look at the market from rose-tinted glasses and talk about it. But the minute I look at individual schemes, small cap stocks, mid cap stocks, the pain I think is real. So what should one do? Because the view you make on the market is normally based on Nifty, and Nifty all-time high par hai.
Yeah, hi guys. If you take Nifty, I think it is all-time high. It is a number which is crossing 11,000 index now. However, it is just a number. If you really see mid cap and small cap, and you rightly said, then the indexes are down 19% and 24% respectively in YTD, the mid cap and the small cap index. So if you take that into account, then Nifty has to be would be like 10,000 number. So if you dig deeper and if you see why Nifty has held on is due to those 5 to 6 good names, good quality names, good fundamental names who have been inching upwards and helping the markets to stay where they are. So there has been a significant divergence which has taken place in last 6 months. That the quality and more fundamental story have taken a lead, and the so-called momentum trades have taken a beating, or maybe the high beta trades have taken a beating. I think the good part is, as I was just hearing your initial comments on oil, I think a good part it is as it has come off. However, I hope it is not a near-term trade, and but it is more of a structural nature. So I think oil prices, global trade war, all is still weighing on the market. So volatility should continue as we have seen in last 3 to 4 months. Anything decisive, either let's say the oil prices coming off by below $70, or maybe this the global trade war tensions subsiding, would really take the overall markets up. So maybe then you can see a mid cap and even the small cap index doing well. But as of now, if you really dig deeper, it is all those 5, 6 good quality stories who have been holding up to the market very strongly.
But Jinesh, do you believe that that's exactly what the texture of the market is going to be for the next 6 months as well, wherein there would be a concentrated few which will hold the markets up? You know, those 15, 20 names, expensive, where there's growth, where there's visibility, and that's where the market is going to be concentrated, and there'll be stark underperformance from the other end?
See, as of now, if you see the overall scenario, despite yesterday's oil price fall, it is still at $74, $75. So it is not that it has come off significantly. So still the macro concerns around trade deficit, the rupee depreciation, inflation, interest rates going up still remains. And also the global trade war is having its own impact, maybe not in a big way, but will have some repercussions in and around some of the companies who will be affected if at all this things go further from here on. So I think, and also please don't forget, you are going into an election season where always there will be some nervousness about how the outcomes would be. So to that extent, we feel that in maybe another next 6 to 8 months, you will be more of a choppy trade. Difficult to get the hang on some of the parameters which are frankly out of our control. The only good part has been the micro India has been doing well. Monsoons are decent. Earnings momentum should pick up, and it will be more stock specific stories in a sector than a broad based rally in that sector. So we have to be very careful and choosy. It is not like CY 2017 where all kind of stocks were going up, either it was a hope trade or it was an earnings growth momentum. I think this year is more of an earnings growth trade, and that is where your money should be.
Okay, Jinesh, I'm looking at your mid-cap fund and you know the performance there. How have you been able to mitigate the volatility and the downside risk that mid-caps have posed? You know, your 1-year return is still staying afloat with about 17–18%. Despite the fact that there's been a fair amount of volatility in the broader markets. And I see large chunky positions taken in high price names like Growth Finance, Bajaj Finance, Page Industries. So what's been the philosophy here to manage volatility?
So I think, yeah. So I think our overarching philosophy has been to be in good fundamental names and take big bets on that, rather than having a 70-80 stock portfolio and trying to play a momentum trade every now and then. We are more of a long-term wealth creation house rather than looking into 2-3 days kind of a trade and trying to churn the portfolio in and out every time. So it's a very, very research-based, focused approach on the portfolio construction, and frankly, that is what has held on. Because the beta of the portfolio is lower than the market beta, and as I said that this year you have seen in last 6 months the entire momentum or the beta trade has collapsed because of the various factors which has come, and I think it is only the fundamental stocks which has hold on, and hence the portfolio has held on.
A good idea to buy stocks which may be called as quality stocks, but they are available at prices which are unfathomable. Growth Finance price to book is more than 10. Bajaj Finance again 5, 6, 7 times. Page Industries P multiple at 70, 80 times. I mean, these are good, great businesses. I know they will survive for a long, long time. But as a money manager, you also have to buy good business at a reasonable price. So where is the price cushion here?
So, Nikunj, to be frank, as of now, if you see the history of these companies, they have delivered year after year in different business cycles, and that is why there has been a truncated trade which has led to all these valuations going up. No doubt they are high from their averages, and obviously we would also like to trim if we have an opportunity in some other name which is offering you a better growth opportunity and the valuation. But as of now, if you see the kind of business momentum they are into, the kind of market share gains they have done, and the ability to manage these business cycles without hurting themselves on the asset quality side, has what has helped them, and that is why I think you have people flocking around to buy those names now. So again, as I said, it all depends. If we get an opportunity in some other name which is a better name than this and is offering a business model which is far superior to this and a growth momentum, obviously we'll try to shift our portfolio. But as of now, we feel if you are taking a 3 to 5 year view, it is more of a time correction in those stories than a price correction.
Jinesh, it's interesting to see, and I'm just looking at some of the recent exits, and this is your mutual fund portfolio that I have in front of me. It has IDFC Bank, it has Ambuja Cement, it also has some of the performers like a PVR and TVS Motor. Why a PVR and why a TVS Motor? Because growth clearly seems to be siding with them. Yes, they are a little expensive, but you know, that's really been the mantra in the market. You've got to pay top dollar for top quality.
See, I think I would not like to go into stock specific name, so I would refrain from giving answer on that front. However, I think it is different funds have different strategies, different schemes have different strategy to follow. So I think it is best up to their knowledge in terms of how they want to position their portfolio.
As a house, what's the call on two-wheelers? Because it's interesting as to how some of these bottom-up stories like a Bajaj Auto, for instance, is getting very attractive. You've seen some great monthly sales numbers being reported by them, exports doing very well. Is that the approach that you're following for two-wheelers, or is it more top-heavy towards the iShares of the world?
No, I guess if you see monsoons are good, rural economy is again thriving. So to that extent, the two-wheeler as a space is looking pretty attractive. We are playing through some of the ancillaries in that. Obviously, in some of the portfolios, we do have some of the names which you mentioned. So it is not that we are only heavy towards one or two names. We are looking into it as and when possible. and we are already pretty overweight on auto as a sector, auto ancillaries, and we have bits and pieces playing around that.
Okay.
Right now, Jinesh, however, would you, I mean, what has been your experience with regards to the inflows that you're seeing across your funds? Is there a tilt towards the large cap funds, you know, especially in the turmoil that we witnessed over the last few months in mid caps? Have you seen redemptions from the mid cap fund, or there is a more skewed interest in multi cap because it de-risks one's exposure, and balanced funds?
So I think clearly, since the as you reiterated earlier about the performance holding on, I think we are seeing good tractions in most of our schemes. However, the intensity of flow, overall flow has come off. So to that extent, we have to live with whatever we get. But generally speaking, I think depending on the investor appetite, depending on the risk-taking ability, we are not seeing any kind of sort of a redemption pressures or slowdown in inflows in any category, at least for our house.
Jinesh, I guess, you know, last 2-3 years, I've got a sense from just about everyone that prepare your portfolio for a cyclical uptick. Prepare your portfolio to migrate from quality to down the ladder stocks, because if the economy recovers, capacities will be created, capacity utilization will go higher, operating leverage would kick in. Somehow that trade, which seems like an obvious trade, is failing again and again. Why is that?
See, Nikunj, first is still the capacity utilizations are at 70, 75. It is inching upwards, but not in a big way as maybe we would have expected 1 or 2 years back. Then you are going into an election season, so none of the big boards will try to go for a big capex at this juncture. It is better to wait for 6-8 months, see the outcome, how it comes, and then take a big bet on the private capex side. So if you see really, the government capex has been very good for last 2.5 years, but private capex has been in bits and pieces. So and hence the cyclical trades are not happening. But just even in that, you have good quality names to play. So it is not that you reduce the quality of the portfolio and go down for the cyclical names. I think there are good names in those categories also. And when, as I said, we feel that the things are turning around on that front, it will happen. Also, please understand the largest capex intensity sectors are steel, cement, and sugar, and henceforth. If you take steel, most of the companies, the good companies are now bidding for the steel assets. So already the assets are in place. So I don't need to go for big greenfield capex for that. So let's say the recent buy of Bhushan Steel gives enough capacity for a Tata Group to manage the steel revenues for maybe around another 3 to 5 years. So then I don't need to go for a huge steel capex. There are those type of 3-4 companies available from the NCLT cases to grab on. So and there are few players now really left who can really take on big capexes. So to that extent, I think since these assets are available at a decent price, why I would bother to go and do greenfield capex? So better I will use those, sweat those capacities rather than going for huge expansion. So that is also a big point in case if you see in last 2-3 years, those names which would have thought of going into a big capex will now go and buy these NCLT cases and suffice their capacity program.
Okay.
Jinesh, what's happening in metals is also quite interesting. After 2 solid years lasting all of 2016, 2017, 2018 has gotten off to a shaky start, and especially now with heightened fear of a trade war between US and China, you're seeing metals really cave in, and quite a bit of volatility as well as kicking in for that space. Would you be tempted to buy the decline? That's assuming that you do believe that the commodity fundamentals is still still intact and it's still very much in an upcycle.
See, ideally, from a long-term wealth creation point of view, if you see the sectors that have created wealth for the shareholders or the investors, have been all the names which are secular growth stories, secular sectors, or the scalable sectors. Unfortunately, commodities as a space is always a good trade of 1 or 2 years, and then it somehow it dies down for various reasons. So generally speaking, we are not big in those sectors. We don't understand that sector that well, because it is more of a global outlook than a domestic led outlook, where you can do your research and try to understand what is happening. There are many factors at play which will decide the commodity basket going up or going down. So not cup of tea, not our cup of tea. So we try to restrict ourselves to limited names in that, and try to concentrate more on domestic stories, where we feel that as your GDP growth goes to 7, 7.5, 8, you have a nominal GDP growth of 11-12%. There would be sectors, there will be companies who can deliver you 20-25%, 2x or which I mean 2x or 3x of GDP kind of growth, and more longevity of growth in that sector. So I would like to play those names more.
Fair enough. Jinesh, we let you go with that. Thanks very much for taking out the time and share with us your investment thoughts and insights.